Okay, welcome back to the next session, and I'm still Malabutubina Emmanuel. You can call me Obi for short. Today we'll be talking about bonds. We're talking about bonds, which is uh, under types of investments. Okay, we've done all this in our previous video. So our focus now will be on bonds. Don't forget we discussed about stocks, common stocks, preferred stocks, and I've given you the attribute. We talked about treasury bills. Usually, it's just for you to know what and what we've done in other videos before as a kind of refresher. Okay. Um. Now our focus will be on bonds. Bonds. Now, I want to explain to you, I'd like to explain to you what bonds are. Now, as I said again, just to repeat, the focus of our training is to open the eyes of entrepreneurs to alternative or additional way of generating income, opening new income skills, developing the financial skills of business owners, of entrepreneurs. However, we are not limited to uh, only entrepreneurs. If you are not an entrepreneur, you could also benefit from this training. Financial skills is basically for everybody uh, because we are consulting company, financial consulting, accounting and tax company. We focus on businesses so that we could help them stabilize their business. So bond, it's a very good form of investment. So what are bonds? Bonds are long-term interest-bearing debt instruments issued by the government or large corporate institution for a specific period of time in exchange for regular interest. The rate of interest at issuance of bond is called the coupon rate. Okay, so bond, we call bond a debt instrument. You could see they are long-term interest-bearing debt instruments. So it means that the risk on bonds is not uh, is not high, it's low risk. That means that your money is kind of secured. Okay, so but they are long term. The difference between this bond and our previous slide, which is on treasury bill, treasury bill are debt security too, but they are short term, less than 1 year. So if you want to go long term, you go for bond. They look like treasury bill. That means that it could be government bond that the government want to borrow money from the public, but for a longer time now, maybe for 3 years, 4 years, 5 years, 10 years, 15 years. You don't call it treasury bills anymore. You now call it bonds. Corporate bond, that's a private company would issue out bonds, okay, to the public, not government now. It's also for long term. So the good thing about bond is that you are sure of getting your interest periodically. Depending on how the bond is structured, it could be quarterly, it could be annually. You get interest. Interest is the money you they'll pay you back for taking risk by investing in those bonds. Okay, it's a return benefit you get from investing. Again, the interest you get on bond and treasury bill is not as high as the return you will get on shares, because shares you are taking more risk, then you get more return. Okay, so let's look at the type of bonds that we have. We have the fixed rate bond, we have the zero coupon bond, we have the callable bond, we have the putable bond, and we have the convertible bond. So what are these types of bond? The fixed rate bond, the coupon rate of this type of bond remain constant throughout the life cycle of the bond, irrespective of the interest rates elsewhere in the market. So the rate, if it's a 7% bond, if it's a 10% bond, if it's a 15% bond, 13% bond, as the name implies, the interest rate they will pay you is fixed. It will not change. It will remain the same irrespective of the duration of the bond. It will not change. So you should get to know that. Zero coupon bond. This type of bond do not pay interest periodically. Rather, just a principal amount at maturity. They trade at a discount to their maturity value. So the rate of return is accrued over time and only paid out at maturity. So for zero coupon bond, that means that they only pay you the principal of the bond. If you're getting a bond of, let's say, 1 million naira, okay, so they will trade it for you at 900,000 naira at a discount, but they will pay you that maturity value. You know, that's 1 million naira. So they give it to you at a discount. So at the end of the period, you get your 1 million naira because you are buying it for a lower amount. Okay, callable bond. This type of bond gives the issuer the right to repay or call the bond before the maturity period of the bond. So that means that the issuer could call the bond that I am the government, I have issued a callable bond. That means that if this callable bond is for 4 years, I can say in the next 2 years, I cannot say, okay, I have enough cash with me. I will call back my bond. I will give you back your money. Okay, it's a callable bond, which is very good. Maybe it's a flexible bond. So that is very good. Tradable bond. Okay, so we also have what they call putable bond. When you say call, put is more of selling, call it like buying. So putable bond, this bond are the opposite of callable bond, as investor have the right to put the bond back into the company before maturity and have it paid. So putable bond means that investor, anytime you need your money, you can sell it back to the company and get back your money. Because one thing about bond is that you are giving the company, not the government, your money. They are giving you a certificate. So you owe the certificate. So anytime you need your money back, you give them back the certificate, they give you back your money. Okay? So because you are in need of money. So you bought a putable bond. You have the right to sell it back to the company. Convertible bond. The investor of this type of bond have the opportunity to convert the bond into shares of the issuing company and participate in equity prior to maturity of the bond. Convertible bond, as I told you, the name sounds convertible. That means that you can convert it to shares. You can convert it to shares. So that's what this convertible bond is all about. Okay, so convertible bonds is very good. That means that if it's something that you want to convert, at the end of the day, you convert it using a convertible bond. But before you convert it, be ensure that the company shares is good. The company shares good. Ensure. Okay, so so you before you buy a convertible bond, be sure that you are converting to a company. The company you are converting into is a good company. Otherwise, you might not enjoy being a shareholder of that company. So do your research. But convertible bond is very good. It gives you the flexibility to remain a bond holder or a shareholder. So if you feel that the company is not too good, you could remain a bond holder. They'll pay you to maturity. Okay. Of course, that's it. You have option for convertible bond. Okay. So bond, what you have what they call bond ratings. That means that before you buy a bond, you need to know the rating of the bond because you cannot buy a junk bond. A junk bond is a bond that does not have value. Okay, very poor in value. So you are buying a bond of a company. You need to know the quality of that company in terms of the grade of that company. So definition now. A grade given bond rating is a grade given to a particular bond that indicates its credit quality. That you want to be sure that you are buying this bond and anytime you want to give them back the bond, that this bond they will pay you your money back then and with interest. So you want to reduce your risk. So you have to go through their rating, ranging from AAA, the highest rating, to C or D. C or D are called junk bond with lowest rating. Okay, so private independent services provide rating. So indication may vary from some rating. Major rating agents in the US are Moody, Standard and Poor, and Fitch. So if you see Moody's rating, Standard and Poor rating, Fitch rating, these are good rating. You can really at least go through those. They are well-known company in the US with very good rating models. Okay, so when you like, of course, looking at some of these company with Moody's and uh, Standard and Poor and Fitch rating. If you see AAA, the grade is an investment. Yeah, it's good. It's an investment. Then highest quality. These are very good bonds. You can buy them. All these very high quality bonds they are usually uh, kind of the interests are usually low because they are taking lower risk. Okay, so people rush them because of they are good companies. So AA, okay, this is how Moody uses his own, this how Fitch uses their own as example. Big letter A, this one big, one small a. So investment, strong quality, yeah, it's also an investment. That is. So if you see a bond rated AA, strong quality. If you see A, just A, yeah, strong, strong. That means good. Okay, you can also buy that. If you are saying B, it's also an investment but medium grade. So you have to be careful. You have to be very careful. Okay, don't just jump into it. And that's a BB or just B like this. BB or just B. But if you see triple B, medium. If you see just one B or two B, uh, it's not my investment. It's now becoming what? Junk. Speculative. Anything can happen. Then you see C or CAA or CA or C, anything that starts with C is also a junk, highly speculative. You cannot really bank on it. If you see just C or D, then that's junk in default. Don't go for that. So these are things you should watch out for when you're doing your research. Okay. Then attribute of a bond. What are the characteristics of a bond? The attribute of a bond, we have bonds are generally very safe investments, and bonds are safe. They are great investment for people who don't like risk, just like treasury bills. Pay attention to the grade of the bond, and bond can be risky or riskier than stock at times. Okay, especially when it's a private bond. Okay, so that's it. So make sure you pay good attention to the bond and don't just jump into the bond because they said it's risk free. Nothing is really risk free in Nigeria and the world, but still check the rating of the bond. But government bond has more lower risk, lower risk. Okay, compared to corporate bonds. Okay, so but however, check the rating, get the bond, invest into the future for long term. Thank you for listening.